Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello, this is The Global View. On Friday, I'm Andrew Gagan. Welcome back to Ausbiz as we get across what we saw on global markets overnight, rallying with the European Stock 600 index closing up more than 0.5% after the European Central Bank kept its interest rates steady. On Wall Street, yet another day of record closes for the S&P 500, Nasdaq and the Dow, despite a higher than expected increase in US inflation, with soft labour data fueling cut bets among investors. Among the mega cap tech stocks, Tesla climbed around 6%. Micron Technology jumped after Citigroup raised its price target on the memory chip maker. Oracle shares, they gave back some of the prior session's 36% surge, which has of course added new fuel to Wall Street's AI rally. Adobe raised its fiscal 2025 revenue and profit forecast, signalling strong demand for its design software and increased monetization of its AI tools. Its shares up 4% in extended trade. Warner Brothers Discovery surged on news reports that Paramount Skydance is preparing a majority cash bid for the struggling media company. Centene shares surged after the health insurer reaffirmed its annual profit forecast and said quality ratings for its Medicare plans were in line with expectations. Delta Airlines fell after the carrier reaffirmed its annual profit forecast. And Kroger raising its annual core sales, forecasting banking on resilient demand for fresh produce. Well, US consumer prices increased by 0.4% in August, the most in 7 months, driven by higher costs for housing and food. The broad increase in inflation partly reflected businesses passing on higher costs from tariffs to consumers. Prices at the supermarket soared 0.6%, notably beef prices up 2.7% to be almost 14% higher from a year ago, while coffee prices are up around 21% from a year ago. Labour shortages at farms caused by the Trump administration's crackdown on undocumented migrants was seen as adding to higher food prices. On the jobs front, initial jobless claims at the end of last week stood at 263,000. That's near a 4-year high, while the real average hourly earnings rate fell from 1.2% to 0.7% year on year. Well, the yield on the 10-year Treasury note dipped to a 5-month low, taking it below 4% following the inflation and jobless data, which reinforced the view that economic conditions are right for the Fed to ease rates for the first time in 9 months next week. The 2-year falling to around 3.53%. And the US dollar index down on the day. The euro bounced off an intraday low after the ECB remained on hold at 2% for its deposit rate, as widely expected, the statement though offering no guidance. And the Aussie has gained further to be trading at around 66.6 US cents, while Bitcoin is at 115,500 US dollars. Oil prices have slid on concerns of possible softening of US demand and broad oversupply, offsetting threats to output from the conflict in the Middle East and also in Ukraine. Brent crude futures selling at $66 a barrel. Copper was up more than 1%, iron ore falling 1% to $105 a tonne. And gold paired losses holding at near record highs following the inflation and jobs data. Spot gold down at $3,633 an ounce. Well, let's now refocus on what we're seeing, particularly on fixed income. Tony Crescenzi joining us from PIMCO. Tony, welcome back. Great to have you on the show again.
Hey, Andrew. Great to see you.
So it looks, of course, as though the rate cutting cycle is set to resume next week. in that environment, that cutting cycle, how compelling are bonds right now?
Well, one has to ask the question, is there room to run? As you mentioned, Andrew, the yield on the 10-year broke through 4% back above it, but yields have fallen pretty substantially, over a percentage point from their peak in aggregate. And so an investor might be concerned. We think there is room to run, even though PIMCO expects 3 interest rate cuts this year and perhaps another couple next year, and markets seem to agree with that, with the pricing of various interest rate futures and other indicators we can look at in the bond market that might seem to suggest that all this news is priced in, and therefore yields can't fall. But an investor has to think of bonds not only in terms of the outright yield, but in a portfolio context. And what I mean by that, Andrew, and you mentioned number of equities and the strong movement in equities. What if, and you showed the figure on U.S. jobless claims, what if the job market weakens more? What if there's a recession? Perhaps then, of course, the fixed income market can fare even better. One final word on this is the idea that the market thinks that the Federal Reserve, when it lowers its policy rate sometime next year to around 3%, 2.75%, 3%, that's where it'll stay. And if anything, go higher the rest of the decade. It won't go below 2.75%, 3%, in other words, according to the bond market's pricing, which gives an investor an opportunity to position themselves for the potential for something bad to happen that brings the policy rate below that pricing, because that 3% pricing is what's widely perceived as the neutral policy rate, and the rate tends to go below that in times of stress.
So, Tony, I see you say that investors really, it's a matter of urgency for them in terms of locking in those yields at these current rates.
Yeah, in the United States, homeowners were pretty smart about locking in low mortgage rates. Over 90% of households have mortgage rates at around 3%, and they locked in to 30-year mortgages, something that we didn't see in many parts of the world, including Australia and Canada. So why not think in the same way regarding income? If it was a good idea to lock in low interest rates on indebtedness, why not lock in higher interest rates on the income producing assets? And we believe that on those income producing assets, that investor can still achieve a yield ranging between 5 and 7% in the global bond market for a portfolio that has a credit quality of so-called AA minus, which is the rating given by Standard & Poor's and Moody's, the rating agencies, that signifies high credit quality, and historically has meant that the investor had a 99.98% chance of getting their money back. And so the climate still looks very good. Fixed income, and an investor should be thinking about the income side of the equation before yields fall more. So I'd say run, don't walk from cash to core, which is to say, rather than have these instruments that mature in a few weeks, few months, or even a year, consider 5, 6, 7-year type maturities to lock in these higher yields.
Do you need to consider those protecting against those downside risks then, Tony? What would your portfolio positioning be there at PIMCO?
Well, a typical bond portfolio in the United States would be judged against what's known as the U.S. Bloomberg aggregate. It's the so-called market cap weighted index, which is to say it contains proportionally the bonds that exist in the bond market. So the U.S. Treasury market is the biggest part of the bond market, and therefore that is the biggest portion of the index. So the next biggest portion is the mortgage-backed securities. We would overweight mortgage-backed securities relative to treasuries. They both have, well, the treasuries have an explicit backing of the United States. The mortgage securities have an implicit backing of the United States, also therefore AA minus. But the perk is the added yield. On mortgage-backed securities today, an investor can achieve a nominal spread, which is a yield above treasuries, of about 140 basis points, or 1.4 percentage points. So it's a way to get a little more juice. So that's one of the areas we want to be. And as I said, Andrew, the key is to stay in high quality instruments because, as you noted earlier, with the job market, it's teetering on stall speed, which is a slow rate of growth that potentially could lead to recession and cause other types of assets, higher risk assets, to do a little worse.
Well, in fact, on that front then, so Tony, I see what you're you're preferring those mortgage-backed securities certainly over corporate credit then?
Yeah, the very interesting thing, Andrew, these days, peculiar in these last couple of years, is that mortgage yields are higher than corporate bond yields, investment grade corporate bond yields. Now, the peculiar aspect of that is how they tend to perform in a recession. So, for example, from PIMCO data, we see that agency mortgage-backed securities during a recession outperform corporate bond securities by 1.3 percentage points. And so that's a sizable difference. Importantly, and the other thing to add on that is that these mortgage securities are highly liquid, which is to say easy to pivot out of. So if there is a case of recession or slower growth that causes those other assets, the credit instruments, to weaken, an investor can pivot out of the higher quality instrument, the high liquid instrument, the mortgage security, into these other assets, take advantage of stress in that market.
What do you see more globally at the moment, Tony, in terms of perhaps that sell-off that we saw with longer debt leading to some losses, but certainly I guess the indebtedness of a lot of nations, look at UK and some of those European nations?
Yeah, the interesting story in the UK, just quickly, is that so-called Liz Truss moment, 2022. The nation seemed to be on a track to increase its indebtedness. The bond market said, no, you won't. Stop. And ever since then, the UK has been in the midst of austerity, disciplined about its spending activity. There may be similar pressures put on France right now, where its yields are closing in on Italy's, which is odd. Typically, the Italian yields are much higher than French yields because the Italians have more debt, but the French are on a bad trajectory. So there's another case of the bond market saying to the fiscal authority, you better watch out, we're watching. In Australia, it's quite the opposite. It's a very good story in terms of total indebtedness. It's one place to diversify in terms of having some interest rate risk, and PIMCO's overweight Australia, with the RBA expected to lower its policy rate eventually at PIMCO, we think, to under 4%, maybe even close to 3.75%. So it's another place to sprinkle a bit of bonds from the global marketplace into a well-diversified portfolio.
Tony, always terrific to get your outlook for fixed income. Thanks so much for joining us from PIMCO.
Thanks, Andrew.
Let's take a look at equities on the local market then, where we're set to get going. Looking for a positive start, in fact. That's off that global rally we saw overnight. So SPI futures up 0.5% at this point, and we'll get right across that in just a couple of minutes' time.